Hi, I'm Josh Misk, Vice President of Investments here at Advisor. This is our December 2015 market update. In this update, we're going to take a look at data out of Europe and China and the US this past month, and as well take a look at our expectations for 2016 and what we think that means for your portfolio. So if we look at Europe, weakness in growth and continued sluggishness in inflation drove the European Central Bank to increase their asset buying program 6 more months out to at least March of 2017. They also reduced their deposit rate by 0.1%. Both efforts were in an effort to try and increase liquidity in Europe. But I think what the market was expecting was either deeper cuts or more money into the asset buying program. So after the announcements were made, there was quite a pullback in the European markets for a couple of days. If we look over to China, continued concerns over the slower growth forecasts as well as weakness in corporate debt has continued to plague the Chinese economy this past month. As we've said before, we think that those concerns are overstated. China has a very large amount of foreign reserves as well. They've shown an appetite to interject if need be, but we do see a lot of volatility happening in China right now. I think the main driver for this volatility, though, is that we're seeing a normalization in the growth rate. Growth rates over the past several years in China have been double digits. Now we're seeing those rates come in around 7 or even a bit lower. Which is still very high, but it's a lot lower from what the market was expecting from before. So as the market adjusts to those new rates, we're seeing a lot of added volatility to the Chinese stock market, and what that's doing is that's putting a lot of pressure on commodities in particular. If we look over to the U.S., as expected, the Federal Reserve increased rates in December. It's the first rise since 2006, but they did indicate that due to global economic concerns, that the future rate rises would come a bit slower than previously suggested. So while there is a risk of increasing faster than the rest of the world and creating a divergence in your policy versus global economic policies, there's also a risk of not rising rates fast enough. Right now we're seeing consumer confidence in the U.S. growing. If it does grow a lot faster than expected, and we see the demand for money become lower, people start spending more money, and inflation starts rising, then they'll have to raise rates quicker in order to keep that inflation in check. So we'll have to keep a close eye on the U.S. economy in 2016 to see how that all unfolds. Here in Canada, the effects of the rate rises in the U.S. will continue to put pressure on the loonie. Weakness in China and weakness in oil prices will continue to put pressure on commodities and oil prices here in Canada, which have made up such a big part of the Canadian economy. So if we look forward to 2016, this slow growth environment and the weakness in emerging markets will continue to put a premium on higher yielding instruments like dividend paying stock and corporate debt. But I think that there's 3 things that we can really focus on in the coming year. One of those things is the price of oil. If the price of oil continues to stay at this low level that it's at right now, you're going to see a lot of pressure on some of the weaker producers. And as those weaker producers fall off, supply should start to come in line a little bit more with demand, and that price will stabilize. I think the second point to focus on is how the market responds to this normalization in the growth rates in China. That'll have a big impact on commodity prices, and I think it'll have a big impact on how the world views other emerging economies in their markets in general. And the third thing is that although we're seeing some bleak headlines, I don't think that the picture is quite as bleak. I think that there's potentially a large upside hidden in the background. Data out of Europe, the manufacturing data out of Europe is strong. If we look at the U.S., we're getting the same picture there. Consumer confidence is growing in the U.S. and employment is high. So I think the big picture there, as I mentioned before, is this divergence in the economic picture in the developed world versus the developing world. and in particular the divergence of the policies that we're seeing in the U.S. versus the rest of the world. So those three points, I think, will continue to keep investors on their toes in the upcoming year. So we should see a pretty volatile market. But I think the key message for long-term investors is that the market is driven by fundamentals like corporate earnings. Right now, corporate earnings look very solid. So I think for long-term investors, the smart move to make right now is to keep a very well-diversified portfolio. That diversification will help protect you against any adverse moves in any one particular market or industry like oil or commodities. And it's the safest way to protect yourself against those downside risks. So that's all I have for the market update for December 2015. If you have any questions, shoot me an email at josh.misk@advisor.ca. Thanks for watching, and we'll see you next month.